Hi, my name is Amit, and I am the Operations Manager at FleetSpark. This is video 18 in our Trucking 101 series. In video 14, we covered how to find loads as a new owner-operator, how to use load boards, work with brokers, and build repeat lanes. In this video, we are building on that. Finding loads is only half the equation. The real question is, which loads should you accept? A truck that is moving is not automatically making money. Revenue is not profit. A load only works if it covers your true operating costs and leaves margin. That starts with one foundation, knowing your floor. Your floor is your break-even point. It is the rate where all your costs are covered, but you are not making profit. Below your floor, you are losing money. Above your floor, profit begins. A load is profitable only when its all-in revenue per mile exceeds your cost per mile. To define your floor, you must understand your costs. There are three categories: fixed costs, variable costs, and driver pay. Fixed costs are expenses you pay even if the truck does not move. Truck and trailer payments, insurance, permits and plates, ELD, parking, and bookkeeping. These bills arrive whether you run or not. Variable costs are every cost that shows up because the truck is operating. Some are predictable: fuel, DF, tolls, routine service, but many are unpredictable. A normal week can turn into a tow bill, a roadside tire call, a hotel while the truck is down, missed appointment costs, or cargo-related expenses. Those emergencies don't just add expenses. They can erase your profit on a load or erase your profit for the week. That's why your variable cost estimate has to include real-world repairs and breakdowns, not just last week's fuel receipt. The third category is driver pay. If you drive your own truck, the business must pay you as the driver. If you could earn 60 to 70 cents per mile elsewhere, that's the market value of your labor. If you don't include your own wage, your cost per mile will look artificially low. You'll think you're profitable when you're simply underpaying yourself. Your floor must cover fixed costs, variable costs, and driver pay. Now we can calculate cost per mile, or CPM. CPM is your break-even operating cost per mile, but to get a real CPM, you need a real mile count. Total miles means every mile the truck travels, not just the loaded miles on the rate confirmation. It includes loaded miles, deadhead miles to the pickup, and deadhead miles after delivery to reposition for the next load. If the wheels turn, it counts. This matters because your costs don't pause when the trailer is empty. Fuel burns, tires wear, maintenance builds, and time passes whether you're loaded or not. Ignoring deadhead makes your CPM look lower than it really is. So, when you calculate CPM, use total monthly miles, loaded miles, plus all deadhead. That includes miles to pick up freight, miles between loads, and miles to get back into a better market. Now, the formula. Step 1. Total your monthly costs. Fixed costs plus estimated variable costs plus driver pay. Step 2. Total your monthly miles. Loaded plus deadhead. Step 3. Divide. CPM equals total monthly costs divided by total monthly miles. That number is your floor. If your CPM is 180, then 180 is break-even. Below that, you lose money. Above that, profit begins. Now let's apply it to a real load. A load pays $600. Loaded miles are 200. You deadhead 100 miles to pick up. Total miles are 300. 600 divided by 300 equals $2 per mile. That's your real all-in rate. Then you compare that all-in rate to your CPM. If your CPM is 190, that load produces a small profit. If your CPM is 210, that load loses money, even though the posted rate looked good. Once you know your floor, you add market reality and margin. Use tools like DAT or TruckStop to see recent lane averages. Then add margin, because break-even keeps you alive, but margin is what absorbs deadhead, delays, and unexpected costs. For example, if your CPM is 180 and you want a 20% margin, your target becomes $216 per mile. That gives you room for normal trucking volatility. Finally, protect your net result with accessorial discipline. Detention, layover, lumpers, tolls. If they aren't compensated, your effective rate drops and you burn margin without realizing it. The shift from finding loads to pricing loads is the shift from movement to margin. Define your floor, use real total miles, and price above your CPM with margin. That's how you stop guessing and start making economic decisions. At FleetSpark, we're a back office and capital partner for owner-operators and small fleets. We help you get fundable, stay compliant, and stay profitable by keeping your bookkeeping clean and monitoring your cash flow and cost structure. And when you're pricing loads or making financing decisions, we help you understand what the numbers are telling you. If you're ready to move forward, contact us at FleetSpark. Thank you for watching, and I'll see you in the next video.